Greetings from Nabo Capital. My name is Masi Njoroge Mwangela, and we're continuing with this series of Treasury Solution, where the content that we're bringing is about how can you generate passive income line from your business. What will passive income do for you? It will not only help you to build your wealth as a business, but it will help you to optimize your cash flows, generate an additional business line, which is called the investment income line, and thereby providing financial security and stability for your business. In this series, our CIO will be unpacking the investment art of how we execute a treasury solution. Tune in, log in, continue to watch this content. If you'd like to receive our newsletter, email invest@nabocapital.com. Thank you for joining. Well, but I'm a CFO. I've been a CFO for 10 years.
Yeah, congratulations.
Thank you. And we did manage our treasury book, but within that wasn't the reason why we were waking up. That wasn't the main mandate. So there were times we lost good opportunities. So if a CFO is listening to this, Damika, and I like what you're saying, a brain surgeon should not do surgery, conduct surgery on himself, why should they come to Nabo? What's the difference between passive treasury management and active treasury management? And what are some of the things that you look at? Let's talk about treasury from a banking perspective. Yeah, I think the treasury that is commonly known on this side of the Sahara is placing deposits with banks.
Yeah.
So from that perspective, what is it that you as the CIO and as Nabo uniquely do that would make me, Mercy, as CFO, really identify with your value addition?
Yeah. So there's actually two levers. The first one is somewhat easy and straightforward. As a fund manager, we make it our business to know our banks. We make it our business to know the relationship managers. So one thing I've heard from firms that have placed fixed deposits is that when they want to get their money out in a rush, they get penalized for the interest. So excuse me, so I'm going to try and do like a segue into a sale here, but a money market fund, for example, right? If you want your money within the next couple of days, you get it, no penalty, no nothing. And that's a function of us really knowing the banks and the relationship managers, but it goes one level deeper, right? You and I could have a great relationship, but if I suddenly wanted to borrow $1 billion, you might say, Damita, sorry, no chance. Don't have the money. And that's where the Camel's risk framework comes in. I wouldn't go into the nitty-gritty of it, but yeah, I'm sure folks can Google it. It's a very robust framework, and it takes into account certain factors that might lead to bank defaults. So I think this was before my time. There was a firm called Chase that went under, caused a lot of unpleasantness. And what I've heard is that in hindsight, if there were robust systems such as Camels in place, that risk would be somewhat diminished. And we are also very disciplined with concentration limits and so on and so forth. So I think the worst situation to be in for anybody is to say, hey, I put money in a fixed deposit, one of the safest asset classes on the planet. Next day the bank goes under and you suddenly lost all your money. So that's Nabo's value add, that risk-adjusted return, knowing the bank, and being able to give you your money essentially faster than a bank does.
Okay, great. So maybe just to unpack this, what Damitha is saying from a risk mitigation perspective, that at Nabo we not only look at the bank from a tiering perspective, a tier 1, tier 2, tier 3 bank that is typically published by the central bank, because the central bank tiers based on the quantum of deposits or the asset size of the banks. We use a risk framework called Camel Risk Rating, and Camel Risk is CAMEL. Camel, C for capital adequacy, A for asset quality, M for management quality. So we look at the quality of the management that is managing these particular banks. E, for earnings quality. What are the earnings? What are these earnings telling us? Because remember, as CFOs and as CEOs, numbers tell a story. And then L is the liquidity metric that we look at. And we do this on a quarter basis, allowing us to reallocate between the banks. If we notice that maybe a particular bank, which is a tier 1 bank, and it has happened, with your permission for me to share, we will reallocate to another bank. So that is one of the metrics that we use at Nabo Capital. The other is the active relationship management with the various banks. There are 47 banks in Kenya?
Too many to count.
Too many to count, yeah?
Yeah.
40-something banks in Kenya. So as a CFO, it is very hard for you day in, day out to be calling, negotiating rates. But because of the nature of the business that we do as asset managers, we are able to manage that relationship seamlessly and also present some of these opportunities for you, allowing you as a CFO to really do your day-to-day business. So thank you, Damitha, for elaborating. Now that you've spoken about risk, let's go to risk management. You know, the difference between banking and asset management.
Yes.
Banking is in the business of safekeeping, while managing regulatory risk from a liquidity perspective. We need to have enough money so that if we've got an avalanche of withdrawals, we're able to meet those withdrawal requests. Asset management, from a risk management perspective, is a value chain, yeah? And within this value chain, you've got your risk assessment, your risk identification, you come up with your mitigation strategies, you come up with your management measures. At times, a risk will crystallize. So please speak to us and educate us around some of the risk measures that you use. Feel free to give us some examples, whether here locally in Kenya or through your professional experience.
Yeah, thank you. So there's many factors of risk. So let me quickly set the stage. A risk factor is something that you cannot diversify away from. So if you take on that risk, right, there's nothing you can do to diversify against it, and it affects all asset classes. Hence the term the risk factor that was coined. Now, since the risk factor terms were coined, what happened, especially with treasury management, especially with asset management, is that a lot of folks ended up throwing it out the water. Because at one point there were around 11,000 proven risk factors. Fortunately, I was lucky. I was studying in 2014, 2016, where in general, the academic community boiled it down to two types of risk: inflation and GDP. So you could see that play out in Kenya, where the shilling depreciating caused inflationary pressures, and it made our debt burden much higher. So that was a huge source of risk. The 5-year bond, I think last year, generated 30 basis points, right? You could have done better by keeping your money in a savings account. So that's a huge source of risk. Then, of course, the GDP shock risk is somewhat self-explanatory. Higher the GDP growth, the better; lower, the worse. So how did academics go from around a multitude of risk factors just down to two? They used several methods, but then they also added one new thing to their toolkit, which is called the value at risk metric. Now, there was a simplistic version of it many years ago, which is not quite useful. But now at Nabo, we use what you could refer to when I was younger as the Cadillac of risk metrics, but now I think people would prefer the Tesla of risk metrics. But what it does is it takes the portfolio and it will do at a minimum 1 million simulations. And after 1 million simulations, we'll come up with what we call the robust answer. Robust just means that if 1 million things happen, we still get to this answer. And that is one of our key risk mitigation tools that we use for especially risk-sensitive clients. So the way you could think about it is, if you give me $1,000 today, and you say, Damitha, in a given year, I can never want to lose more than $2, we can create a portfolio based on value at risk that can give you that answer. I won't get you into the weeds of it. I don't think we have the time.
No, we don't.
I hope this has been an amazing conversation, life-changing conversation to be precise. And I hope that this message gets to as many CEOs, CFOs, general managers, and business leaders out there. And for me, there is only one challenge that I want to throw to all of you who are listening my voice. How much investment income do you have amongst your revenues? What is the percentage of investment income contribution to your revenues? And I would say this, every business needs an investment income line. So I want to say, if you feel this speaks to you, please reach out to us at Nabo Capital. We will be more than happy to sit down with you to explore all the options, all scenarios, and come up with a plan of how we can optimize your investment income line. We can introduce an investment income line to be one of the contributors to your revenues and insulate your business from the turbulent times that we live in. Thank you very much for listening to me. I look forward to engaging you further after this conversation. Thank you, and God bless all of you.